thanks for joining me and my guest today for the latest version of Macro Moves. After last session, which was more of a broad market overview, we're going to be focusing on fixed income today. And I guess one of the reasons we picked this is obviously one of our guests, but also there's been quite a lot of talk about this with spreads being historically pretty tight, but rates still being elevated. Is there still a compelling case for bonds? As I mentioned, I've got two guests with me today. So to evaluate this, we're going to have Ignacio, who's a fixed income product specialist at Pictet Wealth Management, which he joined in 2018, bringing over 15 years of international expertise to the firm. Prior to that, he held senior advisory roles and product development roles at BNP Paribas Wealth and HSBC Private Bank. He's a CFA chart holder who's lived in 8 different countries, and he's also holding a dual master's degree in economics and international business. On the Macrobond side, we've got Philip, who's been with us, Macrobond, for about 5 years now. And he's an economist by training with experience as a macro strategist in private banking, as well as experience developing cross-asset allocation frameworks, including global rates. Before we dive in, I'd like to hear from you. And we're gonna put a poll up for the audience to know what's top of mind for you when it comes to fixed income in 2026. And you can see the different options popping up on the screen, I'm hoping. I guess we'll know soon enough when we see responses. Nice, and we're starting to see them. We're starting to see them coming in. Interesting. So right now, persistent inflation seems to be at the top, and I think we perhaps have. Maybe we'll give like 10 to 15 more seconds for the rest of the respondents. But we've got a tie between geopolitical escalation and persistent inflation. I think let's give a few more seconds, but I think we probably have a winner at the moment with persistent inflation. So I don't know if that's going to change the kind of the tone of the meeting today, but it's we can keep those answers in mind as we kick things off. And I think the first portion we're going to look at here is once Philip starts sharing his screen is going to be an overview of fixed income market performance, which Ignacio is going to kick us off with.
Thank you so much, Dimitri. First and foremost, thank you for putting this webinar together. Thank you for having me. It's an absolute pleasure to be here. Big fan of Macrobond and what you guys are building. So thank you for having me. Very interesting to see the results of the poll too, which I think are very aligned to what most investors and markets are currently talking about. As we can see in the survey, the most selected answer was persisting inflation forcing rate hikes, which of course has been the big topic that everyone is talking about. If you open the FT, Bloomberg, Wall Street Journal, whichever source of information you regularly use, everyone is talking about, as we'll see in a couple of slides, the repricing in terms of monetary policy. But I suggest we start with, as you were saying, with performance year to date on the fixed income market. I don't know if you guys are seeing the presentation. Philip, if you could move to the next slide. On my side, I still have the main one. There you go. What we see is performance across time. Not the one before, sorry. What we see is performance over. Yeah, can you go to there we go. Thank you. Well, we see this performance over different time frames, and the one I'd like to focus on, of course, is year to date. And no surprise, I'm pretty sure our listeners are very savvy on the asset class, and if they've been following the headlines, they've seen that bonds are getting a little bit of a hard time as maybe other parts of the market. But as you can see, pretty much most of it is in red territory. Not surprisingly, what we've seen is a combination of different things impacting the asset class. But most importantly, of course, is everyone is talking about inflation on the back of the Middle East tensions and the war on Iran. Inflation expectations over the short term have skyrocketed, and as you all very well know, inflation is enemy number one of bondholders. So the asset class has been taking a hit. If you add on top of that other headlines such as what is happening on the private credits side, and the wave of supply maybe that we had at the beginning of the year that acted as a negative technical, it's not surprising to see these numbers. Now, what is interesting is that yes, the performance has been negative, but the story has been a little bit different regarding which part of the markets you're looking at. So in the investment grade space, actually, spreads have been relatively well contained and somehow oblivious to everything happening. So if I give you some color on the Euro IG side, spreads are roughly 15 basis points wider year to date. In US IG, we're only talking about 9 basis points wider. So there hasn't been a lot of credit stress from that point of view. On the high yield side, we have a little bit more. We're talking roughly around 60 basis points of widening on the Euro high yield space, and in dollar around 40. So that's a little bit more pronounced. But clearly, there's some part of the markets that have mostly been hit by what has been happening on the rates front, and that's obviously the big story at the moment on credit. So if we look at what's happened, for example, with U.S. Treasuries month to date, and by the way, a lot of what we're going to be talking today is is dollar credit. We took the US as an example, but a lot of the things we're going to say apply to other parts of the market. If we look at what happened on the treasury front, the sell-off has been brutal on rates. Month to date, the 3-year bucket in US Treasuries is wider, almost 50 basis points. The longer end, a little bit less. We're talking 30 to 40 basis points. But of course, as rates moved upwards, the whole asset class has been impacted very, very sharply. Which brings us maybe to the next slide. Clearly the one that is capturing headlines at the moment, what is happening with central banks, right? And I really like this chart that you guys prepared, where we show what markets were pricing a couple of months ago in terms of monetary policy versus what we are pricing in today. And if we take, for example, the blue line, which is the Fed, we see that back at the end of February, we were pricing in multiple rate cuts. Depending on who you asked, most of the market was saying we would have like around two rate cuts, maybe one, maybe three, but most of the market was penciling that in. And today, if you look at that line, it's pretty flat. The market, as of now, as we speak, is pretty much neutral. They don't think that there's going to be any move. But what is also very interesting is that if you look at other central banks, such as the BOE or the ECB, those lines used to be relatively flattish or even downward sloping, and now they're higher. So that means that we are completely changing the mindset, and markets think that central banks are going to step in and they're going to try to address this supply shock that we're seeing coming in from the Middle East with rate hikes in order to contain the inflation. Now, whether that's the right approach or not, and whether supply shocks should be addressed with rate hikes and monetary policy, it's a whole different debate. There's some academic studies that say yes, some others not. But in any case, the markets seem to be pricing at that in as we speak, and hence why we've had this very violent price action over the last few weeks. Now, if we move to the next slide, of course, this has been having a significant impact on the shape of curves. Fixed income advisors, as myself, like to look at this kind of stuff. Historically speaking, as you know, inverted yield curves tended to be a reliable indicator of recessions over the next 18 to 24 months. We were in that world for a couple of years, as you can see in the chart. Now, for the last year and a half or two, the curve normalized. Steepness went back into positive territory, which is good news because economic theory, as you know, says that yield curves should be upward sloping in order to compensate you for taking additional duration risk. But what I find interesting about the chart, as you can see, is that is over the last few weeks, it's been trending downwards. So that steepening that was taking place is now reversing naturally, and following on we saw on the previous slide, the short end has been selling off more sharply than the long end, and that has been leading to a flattening, or let's say a bear flattening of the curve, because the sell-off was created, the flattening was created by a sell-off in the short end that was bigger than over the long end. And maybe to give more color about the type of returns that we can get in different flattening or steepening environments, I'll pass the word to Philip, which prepared a really cool slide with Macrobond that I didn't I didn't know about before seeing it, but when I saw it, I thought it was really, really interesting. What can you add to that, Philip?
Thank you, Ignacio. And yeah, absolutely. I think in general, like you said, it is a dance of finding the right duration depending on different environment. So exactly like you said, prior to the Middle East debacle or conflict, we saw that the market was moving towards a bull steepening environment or a steepening environment in general. However, as you all already know, there is a duration risk. So you can see here clearly in this chart, the further you go to the right, the more volatility you add in your total return performance. But of course, when it comes to the bull environment, you tend to get actually a higher total return or annualized return. However, again, since the Middle East conflict started, we're now seeing a more of a bear flattening scenario, which is basically the red line there. And therefore, there's a lot of conversation about, where you should be positioning yourself in the in this case treasury space. And if you're going to look into creation in Macrobond, so let's see here. Let's see here. So this is basically how you can create this in Macrobond. So in general, um, you have the series here in document list, and in Macrobond you also have a TCA tool, which will actually give you an actual term structure. So it's not just 10 minus 2. It basically gauges the relationship between these yields. And then, of course, with some calculations, including um, identifying different regimes. In this case, as you already know, when it comes to bear environment, or let's say bear steepening, you have the longer end increasing faster than the shorter end. When it comes to bear flattening, it is the shorter end increasing faster than the longer end. And I'm talking about yields here now. Whereas when it comes to flattening, you have the longer end of the yield curve going lower faster than the short, and then bull steepening, you have the long end going higher faster than, or sorry, lower than the long end. Short end goes down faster than the long end. And then basically, again, as you see here in this chart, it clearly captures the the relationship between or where you want to position yourself during different kinds of regimes. And clearly, when it was bull steepening environment prior to the Middle East conflict, the longer end you wanted to go, but now maybe you should retrace those position or duration now when we have this conflict.
Thank you very much, Philip. Seems like there's been a pretty large shift on the rate side. I want to go back to some of the things we looked at earlier, maybe Ignacio, when we were looking at some of the returns we initially looked at and trying to understand where some of these come from across the credit space.
Yeah. So maybe if we move to the next slide, we see an X-ray of where the credit market in general is trading. Of course, we try to arrange this by buckets. But to answer your question, and before I dig into further details here, so what we've seen and what we think more importantly that is going to happen over the next year is when you look at bonds, at credit specifically, you have three main drivers of returns. You have spreads, you have rates, and you have the carry, of course. So spreads, of course, like they're close to historical tights as we'll see in the next slide, but they have been widening a little bit as of late. But if you look at the street, what most analysts think, we expect a year absent a complete global meltdown and recession. We expect a world where spreads should stay relatively contained and around the current levels. Rates, of course, everything is dependent on what happens on the Middle East, which is a little bit binary at the moment. But if you look at the street, once again, a lot of analysts expect rates to stay around the current levels, if not maybe slightly marginally lower now that we had this sell-off over the past few weeks. So the bulk of the return this year according to most analysts out there, is going to come from the carry, and that means the coupon is going to be the biggest part of the job. Now, I always like to look at this type of chart that provides a little bit of a glance, because sometimes people ask me, hey, Nacho, how much is US investment grade paying versus euros, and what is the duration, and so on. And here you have a very clear idea. So in a nutshell, as you can see here, 4.7% for dollar-denominated investment grade papers versus 3.8 in euros. So you're getting roughly 100 basis points more in dollars, of course, because of the risk-free rates. And on the high yield space, the story is a little bit different. You have spreads that are roughly 320 basis points, both in dollars and in euros, and the returns that you can get are north of 7.6 for dollars and 6.2 in Europe. Of course, each of them has different durations. So investment grade always tends to be longer dated in terms of duration than high yield, but a good chart to have under your sleeve whenever you talk to clients, because sometimes someone tells you, hey, I want to have a proposal, or I want to receive ideas that yield 8% in dollars, but with a BBB rating. And the answer is usually me. I'd love to have that too, I'd love it, but unfortunately that's not where the market is trading. So it's a handy one. And maybe if we move to the next slide, obviously the core of the presentation we said was going to be talking about rates and credit. So here's a good one. This is the spreads for dollar denominated bonds, both in investment grade and high yield. Nothing surprising here, as you can see. Over the last couple of years, we had a fair amount of drama. We had COVID, we had the Ukraine war, and then tariffs announcements and so on. But if you look over the last 3, 4, 5 years, spreads were moving just in one direction, which was tighter, right? And we got to a point where we literally traded at the tightest level in history. And hence why so many people thought that credit was expensive. We see over the last few sessions, we have been moving upwards a little bit again, meaning that we got a little bit cheaper relative value-wise. But if we take a step back and look at the scene since 2010, as we see in this chart, we're still relatively close to the all-time tights and well below the average. Now, to answer the first question with which we opened the presentation, should we still be looking at bonds and credit specifically? Does it still make sense to look into this part of the market? In my humble opinion, and of course I might be a little bit biased here, but the answer is of course. And that brings us to the next slide. Why do I think of course? Well, the reason is that we have this kind of paradox at the moment, and this is one of my favorite charts in the world. I like to use it a lot, but we have this tension right now between two camps. One is the one that says, as we saw in the previous slide, spreads are close to all-time tights, and what we see here is the spread versus the yield of the last 10 years. The spreads are on the horizontal axis, and you can see both in IG and high yield how we are on the left part of the chart, meaning that we are at the tightest level of the last 10 years. It's not the absolute tightest, but we're pretty close. Now, that being said, if we look at things on an all-in yield basis, things are not looking that bad. Why? Well, because we saw it. Rates have been going up since 2020, and more specifically over the past few sessions, the move has been quite significant. And as you can see, on an all-in yield basis, on the vertical axis, we're closer to the top than to the bottom, which means we have this weird paradox where we have a market that is tight in credit terms, and that's undeniable. I mean, no one is going to tell you the opposite, but at the same time, it's still interesting and compelling because on an all-in yield basis, you can still get some juice, you can still get some carry. And we know it in dollars, whenever you can show bonds in general, where you don't take significant duration or credit risk, and you're getting more than 5%, and in dollars where you don't take duration or credit risk and you get, let's say, 3.5%, 4%, then you start to capture interest from investors and you see flows coming into the asset class. And hence why I think that despite the tight valuations we're seeing at the moment, it still makes sense to have in most, if not in all, portfolios, a small allocation to bonds. Which brings us to the next slide, which I believe is one of the last ones we're going to be using before opening up to Q&A. But this one also is a chart that I really like. Coming back to that question that I receive sometimes, which is, hey, Nacho, can you show me a bond portfolio yielding 7% with no duration and investment grade rating? And I would say, yeah, I'd love to, but the market is simply not there. And this chart shows you what the market is actually trading. We did it for dollar-denominated bonds for credit, but as you can see, well, the picture is quite comprehensive. And I like this chart because to me, it conveys three main messages. So the first one is, why did bonds become investable again over the last 5-6 years? If you look at the line right at the bottom where treasuries were 5-6 years ago, you could see that almost the whole curve was trading below 1%. Everything was trading below 2%. It was hard to get any yield from treasuries, from risk-free rates, which made it hard to get bonds that were yielding something significant and attractive, even when you added the spread over it. Now, fast forward today, and that treasuries curve, as you can see, is significantly higher, moving around 4% and above, meaning that without doing anything, the quintessential risk-free asset, US rates, are paying you around 4%, and hence why interest is going back into the asset class. Secondly, there is the steepness of the curve. And what you can see is that those lines in the middle, those credit lines, are significantly flat. So in a nutshell, we're not getting a massive amount of compensation for buying a 10-year plus bond in terms of spread versus one that is maybe 3 to 5 years, right? In other moments in time, we had that curve that was, of course, more upward sloping, and where it made maybe more sense to be taking that kind of duration risk. And then finally, not surprisingly, when you look into the difference between investment grade and high yield, where you see that the difference is quite significant in terms of the yields that you can obtain. And of course, the lower you go in the ratings ladder, the higher the yield you receive, which is of course natural. So a slide that I really like on my side too, and one that I like to use when I talk about the asset class. I think, Philip, you wanted to maybe add a comment or two here, and then maybe I can wrap it up with a couple of final comments before passing it to Dimitri.
Yes, Ignacio. So it's mainly for this chart, and I think you have already covered quite well in terms of the relationship between spreads and yields. And if you look into the Macrobond platform, creating these kind of scatter charts is quite straightforward, right? So you add the relevant series. In this case, we added both the high yield and the investment grade for both OAS and yield. You add simply a scatter chart. And then, of course, in graph layout here, let's see here, there we go. You simply just identify, the X and the Y axis, you just line them up basically. And then once you click OK, you get the result here. Of course, you can add chart annotations and so forth. But what I think also that could be good to mention when it comes to Macrobond is that it's not just, top-down macro series. You also have tons of data when it comes to bond indices. So everything from ICE, Bank of America Merrill Lynch, JP Morgan. You have also ICAP for individual bonds, swaps, OIS, and so forth. So with Macrobond, it's very easy to obtain these kind of insights, not just from a macro perspective, but also from a cross-asset, and in particular, in this case, rates and credit perspective.
Yeah, and I think what you build is really cool. I like to think myself as a fixed income nerd, but you guys are definitely data nerds. And if it's not on Macrobond, it's probably that it doesn't exist, right?
Would like to think so.
So maybe just a couple of words on my end before passing the word to you, Dimitri, is that as you saw, clearly a complicated market for bond investors at the moment. Performance year to date has been quite challenging, to say the least. And if inflation continues to be persistent, expect more negative headlines for the asset class overall. But as we also saw during the rest of the presentation and the slides, there is still opportunity. There's pockets of value for those of you that can stomach the volatility and are willing to maybe roll up their sleeves and cherry pick specific names or strategies. There is definitely things to be done into the asset class, and whenever there's volatility, of course, I like to think that there's opportunity. So in my opinion, not an asset class that you should shy away from, but one that you should look into in more detail now on the back of all the headlines.
Thank you very much, Ignacio. And thank you very much for the overall insight. It's quite interesting to see that there's been, I guess, the case for bond looked a bit harder to defend at the beginning, but it seems there's still pretty strong case on the pure yield front, right? It seems the returns are still pretty good. Spreads are tight, and the all-in case remains pretty strong. So hopefully we stay in a job for a bit longer. Before we move to Q&A, I know there's a couple of questions that came in already. It might be good to do a poll to close out as we did at the beginning, which will appear on your screen in a few seconds. And the question here is, what's your most likely portfolio action following this presentation, right? Assuming you had to make a change right now. I think that might be quite interesting. I'm assuming no immediate changes planned would be the main one. But I'm starting to see some others coming in with reducing high yield exposure and potentially increasing cash / short-term bills allocation. Probably not ideal for Ignacio, the cash / short-term bills allocation. But the rest might be a bit more interesting on that front. I'll give it like a couple more seconds, maybe like 5, 6. Add investment grade corporate exposure, reduce high yield. Yeah, so we're seeing increased cash / short-term bills and reducing high yield exposure as the two biggest one, obviously after no immediate changes planned, which is pretty interesting to see after this overview. We can close the now you can see the last results of the poll. I think we can jump to Q&A. There's been a few questions I saw on the chat. There's one that came in on the hyperscaler front, and let me just, oops, sorry, which came in from Agustin. Thoughts on hyperscaler debt issuance hitting markets in 2026? Seems like a fairly strong headwind for corporate bonds, and demand seems to be fading given concentration risk, brackets AI. In other words, high supply and decreasing demand. I know it's a subject we tinkered with before the presentation, Ignacio. Hyperscaler, is that something? What are your thoughts on that one?
Yeah, absolutely. I mean, obviously, when you talk about investment grade this year, this is one of the first things that come to mind. So I read an interesting stat, which was that hyperscalers and tech sector in general is expected to issue around 400 billion this year, which is more than twice what was issued last year. So obviously, that's a massive tech headwind, let's say. And we're already seeing an impact of this on the market average metrics overall. This is probably going to push like the average spread of investment grade in general a little bit higher. Not enough maybe to make it derail, but definitely playing against it. We've seen the news of the Oracles, the Alphabets, and the Amazons issuing massive amounts of debt, some of the biggest order books we've seen in history. In some instances, we're talking around 130 billion of new orders coming in some of the new issuance. So it was absolutely crazy. And we expect more of that, of course. Now, the interesting thing, talking about hyperscalers specifically, is an interesting stat. They can issue up to 700 billion before starting to see pressure from the rating downgrades perspective. So there's still a lot of leeway there. Of course, we're not expecting defaults on those names that tend to be very highly rated. It's more a matter of whether we're going to see spreads widen a little bit. And probably, yes, if they continue printing at this pace and we add a little bit of private credit stress, I wouldn't be surprised. If you ask me, what was not normal is seeing IG spread being so complacent and oblivious to everything happening out there. You saw the stats I showed at the beginning, 9, 10, 15 basis points of widening on IG. It's clearly not enough in my view, and it's something that we're looking very, very closely. Particularly how the hyperscaler spreads behave versus the rest of the investment grade market. If I see those shoot up and the differential become very, very big, that could be one of those cool little canary in the coal mine kind of signals that we fixed income people like to have on our radar, and that's something I have on my files and that I look at regularly. But that's a great question. Thank you for that.
Thank you. And there's another one that came in, and I guess it's kind of a good segue from this one, depending on the answer, but also from the closing poll, which is around what's we've heard from the participants, what's their most likely portfolio action following this. But I guess, Ignacio, what's a credit segment you're seeing today that you currently like, or you think it's worth diving a bit deeper into?
Yeah, that's of course like a good question. It depends on who the person is and risk profile and preferences and current allocation and so on. But what I can say is that at a broad level, some of the themes on the credit space that I've been talking about for a while now that I find interesting. One of them is corporate hybrids. I think it's a really interesting one. So it's a nice way to obtain high yield type of returns with investment grade type of risk or exposure. It's a nice way of going down capital structures, as we like to say, because it's subordinated debt, but without really sacrificing the ratings, because a lot of corporate hybrids are rated investment grade. So this is an asset class, for those of you that is not familiar, that was born out of the treatment of rating agencies, and I'm going to summarize it quite heavily here, but in a nutshell, what happens is at the moment of issuance, these bonds are considered 50% equity, 15% debt. And at the moment of the first call, if the bond is not called, it becomes 100% debt, which gives a very strong incentive to the issuer to call the debt. Historically, an asset class with a very good track record of being called at the first call date. The issuers are very aware of the importance of not disappointing the market. And leaving a few exceptions aside, such as German real estate, there's been very few cases of corporate hybrids not being called. So that's one I like. Another one that we find interesting, also like playing the theme of going down capital structures without necessarily sacrificing ratings, is tier 2 financial subordinated debt, which is, in my view, a sweet spot in banking capital structure, because again, you can get a nice pickup over senior debt without taking as much risk as you would take going into AT1s, the famous COCOs. And that's something that we've been looking into very much in detail over the last year. Of course, like I said at the beginning, there's no bargains, like markets are trading at relatively tight levels. So even those two parts of the market are still close to all-time highs. But something that that I've been looking over the last few months and where I've seen flows and interest coming in from the market.
Thank you, Ignacio. I guess another question that came in is around, are you seeing these hybrid bond on the hyperscaler space as well?
So the big issuers of hybrids bonds tends to be utility companies, telcos, energy, and energy companies, and yeah, those like those that are more into defensive industries or with heavy capex needs and that provide big visibility over the cash flows. But we haven't really seen corporate hybrids coming in from the hyperscalers. They did issue very long dated debt though, in some cases incredibly long, but not in the format of corporate hybrids. They tend to do it via bullet bonds with a pretty plain vanilla structure. The hybrids have more been centered, as I was saying, in utilities, telcos, energy, those type of industries.
Okay. So thank you. I know we had a couple more, but we're also not just at time, we're a bit over time. So might be a good way to close. Any parting thoughts for the audience?
I'll let Philip start and then I'll go.
I think, yes, we are in a very interesting cross-current environment. So, being on the right position in the bond space, credit and rates is certainly an interesting endeavor to do. So, thank you so much for this webinar. Thank you.
Yeah, and on my end, just first of all, thank the attendees. Thank you for tuning in. I know it's an incredibly busy time for all of you, so taking the time to dial in and listen to our views means a lot. And by the way, if any of you wants to continue the conversation, feel free to reach out. You can reach out to me personally on LinkedIn, and I'm sure Dimitri and Philip would be very happy to talk to you too. And secondly, thank you, Macrobond, for the opportunity to participate in this great initiative. I know this is one of the first that you do, not the first. I believe it's the second in the series. But having the opportunity to be here with you has been an absolute privilege, and I can't wait to see the upcoming guests that you have on your radar. It's a really fun format, and I think it's helpful. And best of luck with the series.
Amazing. Thank you so much, Ignacio. That's no doubt big shoes to fill for the next few guests we're going to have on the webinar. And yeah, I'll make sure I might reach out to you myself if Macrobond has a good quarter and I've got a bit of cash to invest in fixed income. So thank you very much, everyone, for joining us today. Any question, don't hesitate to reach out, and we'll make sure the deck is available after the presentation. Thank you.